Hi, everybody. Welcome to the 7 and 7 show with Zack Ellison. Today, I have with me Singh, my longtime friend and former president of Tech Coast Angels, and now managing partner at Alleyway Capital. Sunny, thanks for joining.
Yeah, my pleasure, Zach. Always good to be here with a friend.
So you've got an amazing story that I'm really keen to help you tell. So let's start from the beginning, and your background before you even got into business, I think, is fascinating. So talk to us about that.
Yeah, so I have a bit of an eclectic background, a little unconventional. I was with the NYPD when I was a youngster, I would say right out of high school. And that really changed my perspective and outlook to life about helping people and how things work. And when I was at the NYPD, I saw some, I didn't see, I saw some not so great things. I saw some good things. And that really changed my perspective, made me motivated to go to school. I mean, my parents always used to say, hey, just go to college. Why do you want to do this? But I tried it. I did not like it as much. And then I started applying to college, and my dad was always an engineer. So I started thinking of becoming an engineer. I applied to a bunch of places, got accepted at UCLA, moved to Los Angeles, and then I've just stayed here since then. And it's been quite a journey, honestly.
And what got you interested in the NYPD when you were in high school?
Well, it was all the racial tension and the violence that I saw growing up. For those of you who don't know, I'm Indian, like my background's Indian, so we have some racial tensions now in India, so I bring it up. But it's been something that I've noticed in New York City as well. I had a close buddy that was, violently attacked because he was of a certain race, and then, a certain gang wanted to recruit him. And that got me, very motivated to try to just help people. I was naive at the time, didn't really understand that I could have a much larger impact being on the business side of things and with more financial control and power than I could just being on the streets, right? And that's what motivated me. But then it was a learning process, and I graduated from there with with great experience. But I think college was the right step after.
And you basically were a quant, if I'm not mistaken.
I
And
was, yeah,
so
yeah.
and you told me offline years ago about how you kind of transitioned from the NYPD into becoming a quant, and you got into one of the best schools in the world. So tell us about
Yeah,
that.
yeah. So what happened was when I was a police officer, I started realizing that I had a talent for numbers. Um, didn't quite uh it's just, doing these desk jobs, getting relegated to desk jobs every once in a while for just the way I used to report stuff and talk about it. They would relegate me to desk jobs often. I wouldn't follow instructions very well. That's just my personality growing up. And I realized that I was really good at case numbers, putting pieces together, doing investigations, and that's how I started realizing I had a talent for being a quant. And so I started exploring that option more. And immediately my dad was like, look, you're good at this. You've got to become an engineer. And that's how I went towards, computer science, electrical engineering, started applying for a lot of schools. And I was surprised how much the universities appreciated my background and talents. I thought, people would look down on what I've done and wouldn't really, I had that misconception, but it seems like having an eclectic background becomes an advantage. The diversity and everything else that comes from it becomes an advantage. I know people think that, if you're diverse, if you've got an eclectic background, it's probably harder to fit a mold and get into a good school. That was not the case. That was not my experience. I felt like coming from a different ecosystem with different experiences actually strengthened the outcomes than, just following that, just this vanilla cookie cutter sort of background.
So you were able to you've got two master's degrees and a PhD, if I'm
That
not
is
mistaken.
correct. Yes, that is correct. I've got a master's in IT, and I've got a master's in electrical engineering. And then I've got a PhD in electrical engineering, computer science, which is kind of a mix because I was building systems when I was in my PhD.
So you've also founded a number of successful companies and had exits. So start from the beginning in terms of how you became an entrepreneur.
Yeah, so I think this when I was in graduate school here at UCLA, my professor, who was my advisor, he was very entrepreneurial. That's how, that's just how the chips fell. It was lucky for me. A lot of professors can be extremely academic. He was academic, but he was also very entrepreneurial. He'd launched a bunch of companies before. And we came across this problem in the medical area where we realized that doctors are able to train themselves and tell that a patient's going to get ill or have a pathology in the future. And I was amazed by this because they could listen to the sounds that were coming out of a patient's bowel, or look at the conditions, the way they were walking, the gait that they had, or the way they were speaking, and they could tell if this person's going to have a stroke, is going to have stomach issues, going to have this. They had this sense that they had trained over the years. And the first thing that came to my mind was, could we use AI or some sort of training method to actually have a machine do exactly what the doctor is doing? Like, if it's something that's programmatic and trainable, can a machine do exactly the same thing? Why? And the question in my head was, why not? And the doctors were like, well, that's just how we've learned it. And we don't understand all this, technology stuff. But if you can build something like this, great. And my professor is very encouraging. He's like, you shouldn't look at this as an academic exercise. Try to turn this into a product so that you can be part of a company that actually has this as its primary product. And that set a light bulb off in my head, right? I was like, oh, this might be a startup, you know, this could be a startup. And so I started looking at it that way. I partnered with the doctor who told me about this sort of methodology that they use. And and then my professor got involved. We built a device that you could put on your stomach, your abdomen, listen to the ambient sounds coming from the stomach, and tell if there was a pathology present in your gastrointestinal tract, right? And we did some clinical trials, we trained the device, we went through FDA approval. The device did very well. And that was the startup, and it had a great exit. And that was my first taste of entrepreneurship, obviously as a tech leader. But the thing was that I got so much business experience watching the other guys execute, and it just made me hungry for more. So as soon as I exited that, I sat on the sidelines for a year or so, and I started another company. And this one was just, solo by myself. It was an IT cybersecurity company. And this was not venture backed. The previous company was venture backed. We raised some angel funding, some early venture funding. This company was not venture backed. It was bootstrapped. I wanted to do the whole bootstrap thing because I know there are different experiences. And we started doing IT work for some Department of Defense contractors. The company started to grow, and it was acquired by a PE firm. So that was my second exit. And then that led into everything else.
So you've had two exits, and what do you focus on now at Alleyway?
At Alleyway, we acquire software companies, mostly in the e-commerce space. So my buddy Mahesh Balakrishnan, who I met through investing, and Zach was part of that group as well. We can talk about it right after. But him and we look at software companies that don't have sort of a IPO or private equity exit. They're too small, but we think that they have potential for growth. They don't have the ability to raise VC or venture debt. And we believe that, they still deserve a good exit for the founders, but we have the ability to take those smaller companies and grow them. And that's our sweet spot, anywhere from about 1 million to about 2 or 3 million in annual recurring revenue, software as a service, SaaS, mostly in the e-commerce space. That's what we're acquiring. And it's good because I've seen a lot of companies where I've invested early stage that just go to zero. They have value. They're not able to raise their Series A, B, or B. They have value in what they've created. They just never got the traction, didn't have enough time to just ride the wave of the market. It could be a number of reasons, micro, macro. Those companies still have value, and if we're able to acquire them, it's a great exit for them. At least they didn't go to zero, and it's good for us because we can still put the resources to continue patiently growing the company.
I remember when you were contemplating starting this and we were talking about it, you were telling me about how there's this gap in the market that
Yeah.
you had identified. And yeah, I thought your thesis was spot on then, and is still spot on now. And that there's an opportunity there. There's a problem that's not being solved by others that you and Mahesh are solving.
It's probably even more prominent now given the macro environment in the economy and even more companies not being able to raise equity rounds. Many of them don't even understand the other options that exist. So they just think either I raise equity or die. And for those companies, an exit like ours is great. Raising venture debt is great, and we can talk about that more. There are multiple options, but these companies are just not aware, and that's the problem. They just basically say, "Okay, we're out of cash. We can't raise the next equity round. We have a top line. We have all of these things going, but we're just going to kill everything." So
Mhm. So let's take a half step back, because folks listening don't know your background in angel investing. So you went
yeah,
from Ph.D. in electrical engineering to becoming a two-time founder with successful exits. And then you eventually got into angel investing and became the president of Tech Coast Angels here in LA, which is the largest angel investing group in the country. And that's where you and I used to do a lot of stuff together.
yeah,
And you were membership chair there, you were vice president, and then you eventually became, I think, the youngest president ever in the history
yeah.
of Tech Coast Angels. So you talk about how you got involved with TCA and how you've helped build that organization, and then also what you've learned as an angel investor.
Right. So I started with TCA, I think in 2016 or 2017, if memory serves. So that's close to 7 years now. And initially, when I joined the group, and TCA, for those who don't know, is Tech Coast Angels. It's one of the largest groups of angel investors. Angel investors are typically high net worth individuals that come together to invest in companies in certain sectors, early stage, typically just starting to gain traction or revenue, sometimes even pre-revenue. And this is where most VCs would not invest in a company, and so the angel investing ecosystem comes in, and we put money into companies we believe in. And those companies then go on to raise money for more institutionalized investors, which could be angels, family offices, etc. The ecosystem's changed and it continues to. Sometimes venture capitalists will come downstream, and sometimes when the economy is not so great, they will move back upstream and say, okay, we don't want to be part of the early stage anymore. So that changes, but angel investors typically they stay early stage because that's where the large returns are. And Tech Coast Angels is a group of angel investors with multiple chapters in Los Angeles and Orange County. We even have Pasadena Angels as part of our network now. There are a number of different groups. All these groups are under the TCA, Tech Coast Angels umbrella. I would hazard a guess that we have over 500 angel investors that are part of this network, and it's growing. It's the largest in the nation, and I would think the whole world, but I don't have all that data. But definitely the largest in the United States, and we do about 50 to 60 deals a year. So being part of the leadership at the Los Angeles chapter was a great experience for me, because when I joined, I was very young. I think I was in my early 30s, and I felt very inexperienced. I had an exit. I had already had an exit by then when I joined, but I still felt very inexperienced. As an entrepreneur, you just don't get the discipline and the mechanics of the investing side because you're sitting across the table. You don't understand the decision making, the mindset that the investors have. And so there was this big gap in my knowledge. The only reason the group accepted me, even though I was fairly inexperienced and young, is that I had entrepreneurial experience and I could contribute technically to what they were doing. So if there's an engineering company or a CS, computer science company that came in, I had lots of technical expertise. Then I started learning the ropes and became membership chair, vice president, and then president of the Los Angeles chapter. And that was a phenomenal experience for me. And I will be chairman of the whole board of the whole entity starting next year. So,
That's amazing. And
at least that's what's expected, unless something goes horribly wrong. Yeah.
I don't think it will. I think
Yeah.
you'll do a great job as chair. And you guys are also, when I say you guys, we, because I'm part of Tech Coast
Yeah,
Angels. Tech Coast Angels is now looking to expand more across the country into
that
other
is correct.
states even. So talk a
Yes.
little bit about the growth plans.
So a few different growth plans. We're looking to expand into Tech Coast Angels historically has been on the Tech Coast, which is California, the coast of California. But now we're trying to move over because I feel like the rigor and discipline of angel investors coming together and investing is very good for any high net worth individual or family office, right? Typically, they don't have the kind of expertise or exposure that venture capital firms have. So we joined forces, and I felt that there's a gap mostly in central parts of America, some in the southeast as well. And we're thinking Florida could be a great option, Texas could be another great option, Colorado is another place we're considering expansion. And by expansion, we mean we don't need to go and start another TCA chapter. It could be joining forces with a group that already exists and could benefit from some of the expertise. TCA as a group has been around since 99 or 98. It's one of the earliest angel groups to exist. And given how California has rapidly expanded in the venture ecosystem, we have quite a few large exits and a lot of experience with the members. You know, they're fledgling angel groups that have barely gone through one startup life cycle and don't have any major exits. We already have, I would say, a half a dozen really big exits, and some of those are $10 billion plus exits. So that's the kind of experience we can bring, and I think there can be some real positives by getting innovation in these underserved ecosystems, but also bringing all that investor expertise that a group like TCA brings. So these underserved groups can bring out more innovative companies, and we can bring the experience to help them invest better.
Are there regions of the US that you think have a lot of potential going forward? I mean, you mentioned the Midwest, Florida, and
Yeah.
Texas. Are those the sweet spots?
Those are the sweet spots. I feel like there's a lot going on in Austin already. It's kind of a saturated ecosystem, but there are other parts in Texas that are underserved and starved. At the same time, I feel Colorado is great, Florida is great, and it's because the diverse geographical climate and just the population is different in different areas. They think differently, they have different challenges and problems, and they can incubate companies and look at entrepreneurship in a slightly different way than what people in California look at. And that's just something that you can't replicate. You know, someone growing up in Los Angeles doesn't really think the same way as someone growing up in Dallas. You know, they're just different people. They have like different values, different mindsets, and they look at problems differently. And I believe that sort of diversity leads to good companies that serve different segments of the market. And it's important to have that.
Well, we've talked about some of the investments you've made in diverse geographical areas like Bakersfield,
Yeah.
California, on the real estate side, and you've done quite well with that.
Yeah.
And you mentioned how there's a lot of interesting ag tech startups coming out of places like Bakersfield,
Yeah.
which is Bakersfield. You'll know the market better than I, but if I'm not mistaken, it's basically like the breadbasket, well, or maybe not the breadbasket, the fruit basket of the US. I think half of the agriculture, half of the produce comes out of that region in the US, if I'm not mistaken.
That is correct. So California produces the majority of produce for the United States. And off that majority, the overwhelming majority of California's produce comes from Bakersfield, the Kern Valley, basically. It's that Kern County is a county by itself, north of Los Angeles. And Bakersfield is the major city for Kern County. And that Kern County, the Kern Valley, produces so much agricultural produce that it's mind-boggling. I mean, it's crazy because it's only 2 hours from LA, and I didn't know this till I actually traveled there. On a whim, actually. I just went up there and I saw you cross over into the valley, and it's completely different. It's a different environment, different place, lots of farmers, lots of oil, and different ecosystem. Bakersfield has typically been underserved because people in San Diego or Los Angeles or Sacramento or San Francisco look down on Bakersfield as one of those cities where it's like a backwoods community, et cetera, et cetera. But when you go there, you realize that there's a lot going on here, and that focus on only specific areas by venture capitalists or other investors is doing an injustice to problems that need to be solved in these underserved areas. And that's where we started seeing that some great companies are coming out of Bakersfield. One of the companies that came out, they were using millet, right? The grain. They were using that grain to make vegan ranch sauce, which tasted amazing. right? And then now they're in the shelves in Whole Foods. They're doing a number of different things. Vegan ranch sauce, not from like substitute or filler, but from actual whole grain, and you can't tell the difference in a taste test. I couldn't, and I love ranch. So how would an innovation like that happen in Los Angeles? It can't. We don't have millet here. We don't have farms here. We don't have any of that. So there's just certain things about specific ecosystems that lead to solutions that are just impossible in some of the larger cities.
That's part of our thesis at ARI as well, that there's a lot of underserved areas in geographically, but there's also stages of development that are a bit underserved, and sectors that are underserved, and also groups of founders that are underserved. So I always think of it as the gaps within the gap, in the sense that venture debt is already, a gap in the market, in the sense that there's not a lot of folks that provide venture debt. There's a lot more demand for this capital than there is supply. But then within venture debt, there's huge opportunities, because there's founder groups, which are women, minorities, veterans, that are completely underserved by the current ecosystem. So you've got some tremendous talent that doesn't really have the same access to capital as they deserve. And so there's opportunities there. And then there's sectors that are very underserved, because, as you know, money really in VC it travels to whatever's hot at the moment, right?
Yeah.
Crypto's hot, it goes there. Fintech's hot, it goes there. Now it's all going to AI. And they basically just follow the leader. They're throwing a lot of darts against the wall. It's easy to raise capital in hot sectors. And ultimately, most investors wind up losing a lot of money in situations like that. But that's just the way it is. So what I like to do is look at sectors that are not necessarily hot. So you go find the leaders in sectors that are a little bit less sexy, that don't have that like pizzazz at the moment, but that have really, really good businesses and nobody's calling them.
Yeah.
And I love those types of companies. And then also, to your point, finding companies that are in geographies that are producing something unique based on that geography. Like, people in Bakersfield are going to have a huge edge in ag tech, just like a lot of folks in Texas that I know as well, that are doing stuff in cattle, for instance. And
yeah, there's
livestock.
just no way to do cow research sitting in San Francisco. It's just not going to happen.
Exactly.
So yeah.
Yeah. So we're definitely aligned in terms of seeing these gaps within the gap. I want to take a step back and talk about big picture trends in VC, and kind of where we're at now. From your perspective, what you're seeing, which is quite a lot. I mean, you see from the very early, angel stage all the way to later stage, but are predominantly focused on what you're doing at Alleyway and the angel stage. What are the themes that you're seeing, and how is that affecting VCs and founders?
Yeah, I've seen two major trends. One, the macroeconomic environment has people scared in general. So that has a trickle down effect on every single industry. VCs tend to be a little more they don't tend to be as risk averse as other uh asset classes, right? So they're risk takers. But even they can, sometimes hesitate when the macroeconomic environment's not that great. So it does have that effect. There's a bit of a numbing effect on the VCs where they're like, okay, I'm not so interested anymore. I just want to take it easy. So that's an overall effect I'm seeing everywhere, right? Everyone's little slowing down the velocity of their due diligence, taking more time, dotting the I's and crossing the T's. Um, Rounds are taking longer to close. So that's just the macroeconomic effect. Now, as far as specific trends to the VC industry, what I'm seeing is that initially, because a lot of these IPOs had closed off and quite a few of these exit pathways were gone for later stage companies, their valuation started to drop almost instantly. Early stage is very resilient. It takes time for it to drop all the way down to early stage. So early stage valuations continued to be robust, and later stage valuations started to drop. So you can understand that the later stages are dropping down, early stage the same. There's this crunch point here, right? Where certain rounds, especially B, C, and D, we're seeing really weird behavior going on. That you have no way to go up here, but the valuations here are staying steady. And so founders would hit this wall at series B, C, or D, where they just raise the capital and then just get stuck. Like they had nowhere to go. Now things have started to align back to a bit of a normal curve again, where I'm seeing early stage valuations also starting to drop. So, there's again this gap, but overall, this whole thing has come down, right? Right? Like everything has come down. So valuations in general have dropped across the board. There's a bit of crunch there for a little bit, maybe 6 to 9 months. And now early stage valuations are also trending down. So that's the major issue. There are more investor friendly terms coming in. There's more downside risk protection for investors. Liquidation preferences are back. There's a lot of that. Um, so overall change in more investor friendly terms, valuations trending down, and then the overall numbing effect of the macroeconomic environment where people don't want to make moves very quickly.
Yeah, I've seen all of that as well. It seems like everybody's a lot slower to do anything.
Yeah,
And I don't think that's even just VC or startup
yeah.
land. I think it's everywhere. I don't know if that's a post-COVID trend or what, but people just are not on the ball anymore. They're
No,
just
not at
so
all.
slow to do
Yeah,
anything. No
yeah.
execution
It's
capability.
amazing that you mentioned COVID because that might have a part to play. I don't know what it is, but just deal makers are just lazier.
It's
Yeah,
not even just deal makers. I think it's everybody. I mean, the quality of execution across the board. I mean, it's unbelievable to me. I complain about it every day. It's like my biggest gripe in life right now is just how poorly people execute. On the other hand, it presents a huge opportunity.
of course.
It's people that can execute now are absolute all stars. Just
Yeah.
just showing up to work and blocking and tackling, puts you in the Pro Bowl.
Yep, 100%. If most people that show up right now are already going to win.
Yeah,
Yeah.
exactly. So you're seeing valuations decrease. A lot of startups have been going under recently because they just can't get that next round done, or they can't get it done on terms that they want. So talk a little bit about what down rounds are and how down rounds factor into the funding environment.
Yeah. So for those that don't know the startup ecosystem, we have a number of stages that are, and this isn't formal, but it's something that came out of VC jargon over the years. A company would start and they get funded by friends and family. Then they'd raise the next round, which would typically be called seed, where you're seeding the company. Now there's another round in between called pre-seed. So you have friends and family, you have pre-seed, then you have the seed round. Typically around seed is when you start looking to get your product out and get some traction. And then you raise a series A once you have some traction. By traction, I mean revenue, users, anything that shows that the market is appreciating your product and wants to use it. And this there's one big exception. Certain industries like biotech, traction just means that your science and your research is coming to a point where it's provable and safe, etc. So there you don't have end users yet. You're still, maybe you're creating a drug and you're doing animal tests, and that proves out to be safe and effective. That's traction, right? So as traction goes up, you raise your Series A, then you get more traction, you raise your Series B, you raise your Series D, E, F, whatever, and then eventually you either get acquired or you do an IPO or you become such a massive company that you start becoming the big dog in the space and become operationally positive. You just dominate the market. So that's what typically happens. And what a down round means is that between two different rounds, say Series A and B, your valuation drops instead of going up. Typically, in this cycle, your company's value should continue increasing because you're either improving your traction or your innovation is getting better. You're getting a larger chunk of the market. Your value should go up. The down round is when you're valued at say 10 million for Series A, and then you're valued at 8 million for Series B, right? Like that's that's terrible and that's unfortunate. And I'll tell you why it's unfortunate. It tells the investors in the next stage that instead of your company going up like this and then exiting, your company is going to go up and now it's started to peak and it's falling down. That's the peak for your company. That's a signal to the other investors that you've peaked. Their initial estimations were wrong. You're not going to be the billion-dollar company that you are. And that at this point, it's just people, on a sinking ship trying to salvage whatever they can. That signal is unfortunate because now other venture capitalists don't want to invest, and it's just it's like a vicious cycle that you've put yourself in, and that's why you must avoid down rounds whenever you can. It's a very bad market signal. It's something that's looked at very unkindly in the VC world.
Yeah, I mean, everything you said is it's a bit unfortunate because sometimes it's not the company's fault and they're actually doing quite well still. They were just overvalued initially,
Yes. Yeah.
right? And I think the last couple of years is a perfect case study of what can happen when you have a bubble. So in 2021, mainly 21, but also 20, 21, and 22 were irrationally exuberant years, particularly 21, when companies were getting funded at irrational valuations. Just there was over exuberance everywhere. People were doing a lot of dumb stuff with their money. I mean, look no further than the cryptocurrency market and FTX, which I have to always point out as just, I thought that was completely insane from the start, and I still think whatever is left is insane, and eventually it'll all go to zero. But yeah, we'll see. But long story short, there's um, there's a lot of people that had really good companies that they built, that they funded at insane valuations. And now the problem is, as they go and do their next round, which typically comes 3 years later than the previous round, in most cases, right? Anywhere from like 2 to 4 years, I guess you would say, is when folks are doing their next round. So anybody who did their round in 21 is now coming back to market because they've burned through a lot of that cash. And most VCs are looking at their companies saying, yeah, you're probably worth 20 to 30% of what you were what you were marked at 2 years ago. And so not only is there the negative optics around that, but financially, it means that the founders are going to have to sell a lot more equity to raise that cash also. So they not only lose momentum and have like this huge negative signal with new investors, but their own economics get crushed and their existing investors also get crushed. So that nobody's happy. And this is a nice segue into why a lot of folks are looking at other alternative funding options, namely venture debt. And we've talked for years about venture debt offline, but for folks that don't know, like, how do you think about venture debt from a founder's perspective, and how it complements equity raises?
Yeah. So two things. Venture debt by definition is debt. And for people that are unaware, the capital stack of a company, which essentially says how you've raised your money. To put it in simple terms, how you've raised your money. You could issue new shares. You could give away pieces of the company for money, and that's called an equity raise. And you put a value at every share. And essentially, when you raise with equity, you have to put a valuation on your company. Otherwise, you have to try to, if you want to avoid valuing your company, you're in a bad environment. And we just discussed why a down round is a very bad idea. And in an environment like this, where your company might have been overvalued, you go and try to do an equity raise. You have to put a value on the shares that you're issuing to the new investor, and then you end up in a down round. One of the alternatives, and I think one of the best alternatives, is to use venture debt. Venture debt is raising money through a debt instrument without having to value your company. You're going to raise debt based on the other optics of your business. It doesn't have to be the value of the shares itself, but the type of cash flow you have, the pipeline that you have, just the business potential, which might already be great, but because you were overvalued before in terms of equity, you're being penalized now, even though your business might be doing well. And you want to avoid that by going towards this debt instrument where you raise money against the other business metrics, not your share price.
So it helps founders avoid down rounds, which is huge, which is why we've seen massive demand over the last year and a half. Um, Talk a little bit about how it fits into the capital structure of the company in terms of being a much less dilutive option
Yeah.
and cheaper option than equity.
Yeah, that's a good point, Zach. So Zach brought up a term dilution, right? Typically, as you issue more shares, the value you're giving a larger percentage of the company away to investors, right? So your own equity stake as a founder is getting diluted. You'll have a smaller piece of the company left for yourself. When you exit, the idea is that you can make a decent amount of money based on the sale of your shares at that exit. If you give away all your shares along the way and you're left with a pittance, you don't really make anything. And as a founder, that can be a disappointing result. So you have to be very careful and very strategic in how you raise capital. If you raise capital only by issuing shares, you might end up in a situation where you have nothing left. That's another advantage of venture debt. The money is lent to you. You borrow that money, not by selling shares, but as I said before, based on the other business metrics that your company has. And that really helps because then you're not going to get diluted. You can probably save enough equity so that when you exit, you're happy with the result.
Yeah, I think you explained it really well. And I think that's why we get a lot of demand from founders because they want to keep the companies they built. In fact, ARI's tagline is you built it, ARI helps you keep it.
Yeah.
Right. And the whole concept there is if you wind up selling the majority of your shares, you might build a very valuable company, but now you've got such a small stake in it that it really isn't the outcome that you thought you would have. And so that's a reason that I think venture debt's going to continue to be prominent and grow as a percentage of the total funding pie, because as more founders learn about their funding options, they realize that once they have a company that's got revenue and it has good traction and the ability to support interest payments, then 10 times out of 10 they should have debt in their capital structure because it's a lot cheaper than equity. So the all-in cost of financing on debt is typically a third to 50% of what equity would cost. And you also maintain your equity stake so that when you do exit, you've got a much bigger piece of the pie at the end. So that's why we continue to see just a lot of founders looking into venture debt as a funding option. We've also seen a lot of folks doing convertible notes and basically trying to use those as it's really equity, but technically it's a debt instrument, but it's really it's a hybrid, right? And so there's a lot of folks doing those, but you can only kind of bridge to the future for so long until you actually have to go out and do a big traditional equity raise to get you to the finish line. So I think we're going to see a lot more of that in 2024. What's your thought on timing in terms of when the market's going to start to loosen up and we're going to see more equity capital start to flow again?
I think this is just the start of all the troubles, unfortunately. Um, these issues have been a long time coming. People have been expecting it for a couple of years now, and finally seeing, the issues in the market trickle down to the startup ecosystem. I think this is just the beginning. Um, at least a couple of more years where equity financing is going to be hard. I'm expecting more than that. So 2024 and probably 2025, you should brace yourself to survive. And I think if you want to grow, you need to look at all alternatives. You can't just go with equity financing. I think venture debt's one of the great alternatives, unless you really just want to exit and sell your company, which is a different situation. But in these desperate times, if you try to sell your company, you're not going to get the kind of exit you're expecting. So if you can survive and if you can continue to thrive and you actually have a great business, just can't raise your next round, people should be looking at venture debt. At least 2024, 2025, the environment's going to continue to worsen, potentially 2026.